what's going on. All right, DCM Shriram reported numbers, and they posted a tepid kind of second quarter, led by a weakness in the vinyl and sugar businesses. The company has seen profits slip by 20%. Operating margins have also contracted sharply to 11% compared to 15% last year. Amit Agarwal, ED and CFO at the company, joins us. Amit, good to have you with us here. Thank you very much. So just start with the vinyl business. I mean, I think last quarter also you had indicated that because of the slowdown in China and they being, I guess, more export-oriented, that's a segment which is suffering. Can you talk to us a little bit about what's happened in the quarter? I think there is a EBIT loss. What's the outlook there in that business?
Yeah, thanks for having me on the show. See, the business which has got significantly impacted is the vinyl business. That's largely driven by the global factors, and because there is a demand slowdown, given that the construction globally is coming down, given the recession fears, and coming from higher interest rates and things like that. So that's there to stay. But there's also a positive side to it. What happens is when the PVC production is down or capacity utilization is down, which means that the key input to that, which is chlorine, there also the capacity utilizations in the chlorine producing plants is low, which means caustic output is lower. And therefore caustic prices for us remain supported. So we are also into, we are one of the largest caustic suppliers in the country, manufacturers in the country, and that supports our prices.
Okay, so what do you see as the way forward in terms of, all the businesses? I mean, just trying to understand, do you think that you could perhaps head to even single-digit margins because of the pressures that we're seeing? You're currently at about 11%, but just a ballpark number that you expect for the full year?
See, for the full year, for company as a whole, the margins should be in the range of 14 to 15%.
Okay.
Because if you see, except decline in PVC, the chemicals business, the caustic soda chlorine, that business is stable. Slight dip in margins. Last quarter we had 35% EBITDA margin. This quarter we had 30% EBITDA margin, and I expect these margins to be around that levels at least for next quarter. And if you see all the other businesses, whether it is farm solutions, Fenesta, fertilizer, all the businesses have done well. So therefore, I really don't see any significant pressure. On top of that, the sugar business, which because of its seasonality, it will see better performance in the coming 2 quarters, and therefore the margins have to come up in the rest of the year.
Actually, that was my follow-up question for you, because the sugar business is still loss-making, right? There's an EBIT loss of 15 crores. So when you say better performance, are you expecting to turn into the black in this fiscal itself? Because you're putting some capex on board as well.
Yeah. So see, because as I said, because of seasonality, when the production starts in the coming quarter, the business will turn into the black in the next quarter itself. So that's very clear. The reason why there were losses in the current quarter, one, there were one-time impact because of certain circulars which got issued by the government, wherein we had to take almost 15 crores one-time impact, right? So that's point number one. Second, in the last season, there were higher cane costs and certain other consumables were higher, because of which the sugar cost was higher, which could not be fully compensated by the output prices, which also went up but could not fully compensate. Now, going forward, the profits will increase. Secondly, as I said, and I always feel, as a company, the way we feel that we need to invest in growing volumes. And that's what we are doing, whether it is sugar business, whether it is chemicals business, we are investing in growing volumes, whether it is existing businesses, or it is new lines of business, or it is circular economy, innovation, sustainability. That's what DCM Shriram stands for today, and it will stand for in the future.
All right.
That's what we're investing about 3,500, 3,600 crores to drive our volumes over the next 1.5 years.
Very quickly, Amit, we are bracing for market opening, but your second half of the year, you'll have to do margins of around 16-17% to get to that average of around 14-15%. Yes. So we'll hold you at that, because of the first half of the year, it's been in the early teens, 12-13% odd. Sure. Amit, what about the top line growth? If you could give us, what is for the business, what is it likely to be? And you just briefly mentioned that about that capex of around 3,000 crores. So how much of this will be funded by debt? What will be your peak debt level? Very quickly.
Answering your first point, our revenue should be in line with what we've seen in the first half of the year, right? And in terms of my debt levels, by end of the year, I'm expecting my debt level to be in the range of around 1,700 crores, plus minus 100 or 200 crores here and there. And because the capexes will complete by Q1 of next year. So therefore, there will be some amount of debt coming in next year as well. But that's the kind of debt levels I'm seeing.
All right. Thanks a lot for stopping by and speaking to CNBC TV18. That's DCM Shriram under pressure.